my talk this morning is called Good Reasons to Ignore Valuation. Now, Brian Bears talked a little bit about this, and I'm going to go into it a little bit more. So if you are a value investor, I want to give you a special shout out for giving me some of your time so I can tell you why there's good reasons to ignore valuation, which is something that I have personally struggled with in the time that I've been investing. So before you think I'm some kind of crazy, nutty, buy anything at any price, a little bit about me. I am a natural saver. I am a card-carrying member of the Financial Independence Retire Early community. So when I go to the grocery store, for example, my eyes go here. I love buying things on sale. I love paying as little as possible and getting as much value out of my purchases. That's just core. That's a core part of me and my money philosophy. So when I first started investing, I loved seeing this. I love seeing it when stocks were down. That would make me excited. I would be buying, I had the opportunity to buy stocks at a lower price than I did before. My point is, I'm a natural value investor. So when I started out investing and studying the greats, and I saw guys like this say things like this, all intelligent investing is value investing, I bought it up immediately. Yes, Charlie, you're right. All intelligent investing is value investing. I buy it. I'm in. And when I hear guys like this say things like the most important words in investing, margin of safety. Yes, Warren. Yes, I get it. I'm in. Buy companies at a discount. That's what I'm trying to do. That's how you make money in investing. I just immediately was attracted to this idea. So whenever an idea would come my way as a new investor, I created this valuation filter for myself. And only stocks that would get into my portfolio had to go through that valuation filter. That's just the way that I invested when I first started out. I know if you're a value investor, this is probably how you invest. Valuation is the lens through which you see the investing landscape. This is how I was. So I want to rewind back to 2006 for a second. At the time, I was working for a startup medical device company. We were in the midst of commercialization, and we were in the market for a customer relationship management tool, software to help us run our growing operations. We tried 2 tools that were terrible. They were clunky, they were on-premise, they didn't work well. The third tool that the company tried was a new tool based in the cloud. It's called Salesforce.com. I immediately was attracted to this tool. I immediately saw the value, and within a matter of months, our entire company became extraordinarily dependent on Salesforce.com. If Salesforce.com went down, we aren't shipping product. If the phone's ringing, we have no idea who it is. And I thought, this is a really cool tool that's differentiated in the marketplace. I wonder if this company is publicly traded. Well, it was. And I looked it up. And at the time, the market cap was about $3.5 billion. The price to sales ratio was 10. Keep in mind, this was 2006, so that was a crazy number back in 2006. And the price to earnings ratio was 160. 160. So what did I say? Nope, stop, full stop. Can't buy this company. Way too overvalued. Way too overvalued. Well, if anybody has been following Salesforce.com, at the time, there was absolutely no margin of safety in the company. But my valuation filter kept Salesforce.com out of my portfolio. And if you've watched what happens to Salesforce.com since then, you know that it's been one of the best investments that you could have been making. The company is up 32x in value and growing. I had the insights into this company 15 years ago as a consumer, and I didn't buy because of valuation. So I missed out on a massive, massive winner. Fast forward to 2009. I was starting to learn more about investing, but I assure you that my valuation filter was still in full force. But I started listening to this guy, who I know is a past speaker at this event, David Gardner. David, for those that don't know, invests completely differently than I did at the time. David goes after high growth, disruptive companies, and he is very willing to pay any valuation for a company if he thinks it has a long-term growth trajectory. So in 2009, I started listening to him, and he recommended a company called Amazon. Now, Amazon, the business, checked just about every box that I look for in a great company. I obviously knew it as a consumer. I was a prime customer at the time. However, that valuation filter came up, and I said, oof, $56 billion company, price to sales not too bad, but 80 times earnings. The PE ratio is 80. You can't buy that. Way too expensive. Got caught in my valuation filter. But after following David for a couple of months and years, he recommended Amazon again. And he recommended Amazon again. And he recommended Amazon again. And over time, after seeing how each of those previous recommendations were doing, he got to me. And I said, all right, he's a better investor than I am. I'm going to make an exception. I'm going to temporarily bypass my valuation filter and let Amazon into my portfolio. This was 2010. That turned out to be one of the greatest investing decisions I've ever made. And I've added to it several times since. So despite it going against all of my principles that I knew about investing at the time, buying Amazon turned out extremely well, even though I thought it was way overpriced at the time. And that process kind of repeated itself numerous times with other great companies. They would get recommended to me: Netflix, MasterCard, Mercado Libre, Tesla, Shopify. And all of them would get caught immediately in my valuation filter. But slowly, I learned maybe I should actually let these companies through. I like everything about them. And I gradually let them through and into my portfolio. And spoiler, those have been some of the best investments that I've ever made. Now, when you study the market and the market's returns, it's a minority of companies that drive the majority of the company's return. And some guy on Twitter that I follow recently said something that resonated with me. It's humbling, inspiring, and a bit scary when you realize that one great investment can make your year, decade, or even career. This is a fascinating concept that's really hard to wrap your head around. But as I thought more about this and studied it more, and I looked back on some of the greatest investors in history, I really think that this tweet is dead on accurate. I know that you guys know who this guy is, and I know that you know his history. It's only in the past, say, 2 years that I really discovered his true history, Ben Graham's true history. And I think it's fascinating for those that don't know the story about Ben Graham and Geico. For those that, everyone here knows what Geico does, but you might not know Ben Graham's history with Geico. So Ben Graham broke so many of his investing rules when he invested in Geico. First off, he bought 50% of Geico in 1948 for about $700,000. He bought half of the company in 1948. Now, that broke one of his rules. First off, it was 25% of his partnership's total capital. He previously capped any investment at 5%. And while he did get it at a discount, it wasn't a screaming discount that we know and think of when we think of Ben Graham, the inventor, the father of value investing. It was a 10% discount to book. Now, how did that investment turn out for Ben Graham and Newman? Well, they turned $700,000 in 1948 to $400 million in 1972. 24-year period, over a 500 bagger in Geico. In Geico, the profits that they made from Geico outstripped all of the other investment gains in all of their other investments combined. So in a very real way, Ben Graham owes his long-term success to one great investing decision. And I love this quote from him. In 1948, we made Geico our investment. And from then on, we seemed very brilliant to people. I love that. Now, why was Geico such a good investment for Graham and Graham Newman? Well, yes, he bought it at a good valuation. But I think Geico was such a great investment because Geico was a great company, a truly phenomenal wealth creation machine. And that's the thing that mattered. In fact, if you go back to 1948 and say, would you invest in Geico if it was trading at 1x book value? Instead of 10% discount, would you pay full price for it? Was it a good investment at 1x book value? How about 2x book value in 1948? How about 5 or even 10 times book value in 1948? If Graham paid 10 times book value, literally more than 10 times what the valuation cost him, would it have been a good investment? The answer is unequivocally yes. Instead of turning 700,000 into 400 million, if he paid 10 times book, he would have turned it into 40 million. It still would have been a phenomenal investment. Phenomenal. So when we learn things like that, I think the key lesson that I take away is getting great companies into your portfolio is so much more important than getting them in at great valuations. Getting the mega winners of tomorrow into your portfolio is more important than getting them in at great valuations. Here's another example of this phenomenon. If you are familiar with this picture, it's Masayoshi-san from SoftBank, shaking hands with Jack Ma, the founder of Alibaba, buying a 30% stake in 1999 for $20 million. That investment went on to go up 6,500x. It's one of the greatest investments of all time. And say what you will about SoftBank and what they've done with some of their other investments, it doesn't matter. It doesn't matter what all their other investments have done because they made this one deal, and this one deal was the only deal that mattered. They made so much money off of Alibaba that it made their career. Now, when you study the long-term returns of the market, this is not abnormal. This is how investing works. This is how index funds work. I love this graph from Blackstar Funds that shows between 1983 and 2006, the collective return of the bottom 75% of stocks was 0. All of the return of during that time came from the top 25% of stocks. And it's a power law distribution where only a minority of stocks drive the majority of the market's returns. A similar study from JP Morgan and FactSet of the Russell 3000 showed something similar. It's really the extreme winners, which are about 7% of all stocks, that drive the market's return. And if you are investing to outperform, if that's your goal, getting these stocks into your portfolio is what matters. Can you get these stocks into your portfolio? Can you find, buy, and own them? Now, I know you guys talked about this recently, but I loved this recent tweet on your 10-year anniversary. And the numbers that you guys throw out match pretty closely to this. 876 stocks, 255 are up 100%, 49 are up 500%. So that's about 7%. 6-7% of the total, and about 3-4% are 10 baggers and growing. And I fully agree with the very last line of the tweet. Slugging percentage is more important than your batting average. Doesn't matter how many times you strike out, because in investing, you can hit a home run that's worth 100 runs. And the real thing you're going after that matters is how many times can you hit home runs that score 100 or 10 or 50? That's what matters to long-term investing returns. And I also took a look at your best performers. You guys have some great stocks on this list that have done unbelievably well. But let's take a look at XPEL in particular. XPEL was highlighted in MicroCapClub in June of 2013 at 36 cents per share. Well, looking back on that recommendation, at the time, XPEL was about $11 million market cap, and it was trading pretty cheap. Less than 1 time sales, about 8 times earnings. But I ask, would XPEL have been a great investment in June of 2013 if these were the numbers? If you literally had to pay 10x the valuation that was available on the market, what would the return be in June of 2013 if you bought XPEL and paid 10 times the price? Well, if you bought that and that was on your scorecard at 10 times the price, it would be here. It would have been your 8th best investment of all time if you paid 10 times the price. So XPEL in June of 2013 was a phenomenal buy, no matter the valuation. You could have paid 10 times the valuation and still done unbelievably well. Again, getting the mega winners into your portfolio is more important than getting them in at a great valuation. And finding those 7% of stocks that drive all of the return is what matters. But what is it about that 7%? Where does that return from that 7% of stocks come from? Well, I love this study by BCG and Morgan Stanley that showed what drives long-term stock performance. Well, in a 1-year period, the thing that really drives stock performance is the multiple. Changes in valuation. What matters in the short term. But over a 10-year period, the thing that really drives stock returns is sales and profit growth. Sales and profit growth. It's finding and owning those companies that can significantly enhance their revenue and significantly enhance their profits. That's what leads to long-term stock market outperformance. So when I learn these kind of things, it makes me question whether or not seeing the world through my valuation filter still makes sense. And that valuation filter is, I'm not the only one that has that. There are a lot of investors out there that naturally have that valuation filter built in. And I'm going to tell you 3 things that I overlooked, 3 reasons why going with a valuation filter was the wrong choice for me initially. The 3 things that I didn't understand about investing. The first thing I didn't understand was I didn't really fully comprehend exponential growth. It's a shortcoming. The second thing that I didn't understand was the business growth cycle and how I was using the wrong tool at the wrong time. The third thing that I didn't understand was black swans. We'll get into each of these. Let's start with my own inability to understand exponential growth. Humans, myself included, are naturally programmed to think linearly. 1, 2, 3, 4, 5. This is how we view the world and how we see the world. Linear growth makes sense to us. But we all know that investing works exponentially. Compounding works exponentially. So in the first early years, the 2 numbers look identical. It's only in the late years that the results start to diverge significantly. And this is why I had such a hard time understanding the S-curve and disruption and the business life cycle. I know that you all are familiar with this concept, but I want to cover it quickly. When a disruptive technology or disruptive business comes along and it's launched, the first period that it goes through is the infancy stage, when it's perfecting the technology, bringing down costs, finding use cases for it. And this process can take years or even decades. Eventually, the technology reaches the critical tipping point, and then it goes through a massive expansion phase. After the expansion phase, it reaches the maturity phase and the growth normalizes. But this is how technologies and disruptive ideas are adopted. And if you look back at history of some of the most disruptive technology that have been invented over the last 100 years, they all follow an S-curve. Electricity, radio, air travel, video games, the internet, MP3 players. And if you look at the shape of the S-curves, you'll notice they're getting steeper. They're getting steeper. The adoption rate of disruptive technologies is accelerating. It's getting faster. And this actually works within categories too. Here are examples of disruptive technologies in specific categories. Two of these we've lived through recently, relatively recently. I remember buying DVDs and VHS cassettes, VHS tapes as the way to get movies. But then along came digital and streaming, and DVD sales have plunged because it's so much more convenient and better to stream. And on here, I remember buying film cameras. And when digital cameras came along, how slow and clunky and bad they were. And nowadays, film cameras are a relic. People that have them are hobbyists. These disruptive technologies were adopted via S-curve within the product category. This is how adoption works. And this explains why when you look at Amazon's revenue, this is exactly what's happened. In the year 2000, Amazon, a disruptive company, had $3 billion in revenue. By 2010, that figure jumped to $25 billion. By 2020, $238 billion. And over the trailing 12 months, $443 billion. That's disruption. Now, can you imagine being an analyst in 2000 with $3 billion in revenue and forecasting out 20 years and saying, we think Amazon's going to do more than $400 billion in revenue? You would have been laughed at. You would have been called crazy. But this is how disruption works. And this is why when there are people out there that study S-curves and believe in S-curves and forecast in S-curves, they're often called crazy. When they say things like 95% of people won't own a car by 2030, or they say things like Tesla is going to 3,000. The reason they seem crazy is because they're assuming the S-curve is going to work out. And if they're right, their forecast could prove accurate. They know and study this. But boy, is that a hard thing to do. If a company is here and it's priced as if it's here, that gap is a really hard thing for many investors, myself included, to pay. That's a huge premium that investors have to pay oftentimes if they want to get in on companies that are disruptive ideas. But if that company is that snowflake that can ride that S-curve up and end up here, buying way down below was a great move, even though at the time it looked crazy. So what kind of technologies or disruptive technologies are out there that could be in this stage right now? Well, I keep an ongoing list, an updating list, and I'm up to almost 90 now. Now, will all of these take off? Will all of these follow an S-curve? Will all of these be great places to invest? No. Many of these will falter. Many of these will fail. But some of them will succeed. And those that could succeed have a chance of riding that S-curve higher. So this is one thing that I didn't fully understand or appreciate. 2, I misunderstood the business growth cycle And this was a really costly mistake for me, especially with the price to earnings ratio. I'm going to quickly talk about the life cycle of a company, of a highly successful company that started today. The first stage of a company is the R&D stage. No revenue. They're building out the product or the service. From there, they go to the launch stage. It's very common for companies that are in the loss stage to be losing money, no profits. Profits are negative. Eventually, if the product or service is successful, which is what this chart is assuming, they go through a hypergrowth stage. And at that point, they reach a break-even number. And at this point, revenue is growing quickly and profits is going quickly. And a key term that I didn't fully understand, operating leverage, is kicking in. After that hypergrowth stage, they reach maturity. Their growth normalizes, their profits normalize, they become optimized, and then they reach a decline phase, and both numbers head down. Now, each of these phases could be years or decades, and all companies don't follow this exactly, even successful ones. There are some that are in the launch phase and become profitable immediately. There are some that are in hypergrowth phase, and they're losing money for a long period of time, but this is the way that I roughly think about the phases of a business. And in this phase here is the trickiest, one of the hardest things for investors to wrap their head around. But this is a phase when operating leverage is kicking in. Here's an animation that shows operating leverage in action. And it's, for those that are unfamiliar, it's just a concept where after a break-even point, a company's profits can grow at a much faster rate than its revenue as the business scales. Margin improvement just leads to operating leverage, which allows profits to grow much faster than revenue. Now, what kind of valuation metrics are appropriate at each of these stages? Well, in the R&D phase, it's the price to hope ratio. Price to cross your fingers that this technology works out. There's nothing you can really use. In the next phase, in the launch phase, the price to sales ratio is as good a guide as any. The price to sales ratio has lots of flaws, but at least there's a number to look at. There's revenue to look at. The next phase, you can start going further down the income statement for valuation purposes. But I think something like price to gross profit is a good proxy. Price to EBIT is a decent proxy. God help you, but price to adjusted EBITDA, it's something. Boy, do I hate that metric, but it's something. But only when you get to the maturity phase can the price to earnings ratio start to be useful. And in the decline phase, I don't think there's anything that can save you. There's no valuation metric that can tell you Blockbuster was a good buy or Circuit City was a good buy. But the problem that I had, and the thing that I got wrong, was that I thought that this metric here was universally applicable, and that the price to earnings ratio should be used throughout a business's life cycle. Well, that's just flat out wrong. You can't use valuation metrics when they're in the wrong category. This is why in 2004, when Amazon's PE ratio was 675, it then returned 6,300%. Because at the time, 2004, Amazon was about here. The PE ratio is over here. It doesn't work yet. And this is why people were screaming, Amazon's PE is so high. They didn't understand operating leverage, and they didn't understand the growth trajectory for the company's profits. This is a hard lesson that I had to learn. Now, another point that hammered this concept home for me was an article that was written by Morgan Housel a few years ago on The Motley Fool. Morgan did something brilliant. In 2012, he looked at the 30 Dow components, and he asked himself, the 30 Dow components today, what were these companies' actual PE ratios in 1995? And then he said, what PE ratio would an investor have been willing to pay, should have been willing to pay in 1995 to earn a market matching return of 8% per year. And here's what he calculated. I realize these might be hard to read, but there's a couple of things that stick out on here. In many cases, some of the greatest companies on this list were dramatically undervalued, even though their PE ratios looked pretty high. United Healthcare, for example, had a PE ratio of 28, but an investor could have paid 76 times earnings to earn an 8% return. United Health at 28 times earnings was dramatically undervalued. Conversely, there were some stocks on this list where the exact reverse. Alcoa was trading at 10 times earnings, seemingly cheap. But if you wanted an 8% return over the next 17 years, you would have had to get Alcoa at 3 times earnings in 1995. So Alcoa and Bank of America and Hewlett Packard, with their seemingly low PEs, were dramatically overvalued. That's a hard concept for me to wrap my head around, which is why I like this study so much. The third thing that I didn't fully comprehend was a Nassim Taleb concept, black swans, unforeseen events and their impact on society. Humans evolved with this, the bell curve. We're used to thinking things like this with like height distribution, performance distribution, athletic distribution, coin flips, etc. This is how we evolved over thousands and thousands of years. Nowadays, this is the world we live in, the long tail, the world of exponentials. These are two fundamentally different worlds. So when you think about valuation and forecasting, we're naturally thinking of that bell curve model, where 99% of the time, the world is roughly predictable. But 1% of the time, something happens that makes the world go into chaos. Think about the months leading up to September 11th. How much of our current worldview and society is impacted by the months leading up to September 11th, 2001? Then ask yourselves, how much did our worldview change in the 5 hours of September 11th? That black swan event that came. Years and years was overwhelmed by what happened in a matter of hours. That's a black swan. 99% of the time, we live here. And in this world, black swans don't matter. Valuation models make sense. 1% of the time, this happens. And valuation ceases to matter and ceases to work. Anyone remember this? Chipotle being in the news, the burritos causing people to get sick. Well, if you were a shareholder of Chipotle like I was and still am, while the stock was reasonably valued, 48 times earnings, reasonable given the company's growth, you still had to sit through a 60% loss over a period of years as the company dealt with that black swan. That was a bad black swan for Chipotle. Did valuation matter when this was happening? Was there a discounted cash flow ratio, this DCF model that accounted for this happening? Nope. How about this company? When COVID hit, sometimes black swans are positive. This company skyrocketed in usage, and its PE ratio was 1,200 in January of 2020. And then it went on to multi-bag because of a positive black swan. When I learn about things like this, this is one of the reasons why I personally don't use discounted cash flow models. They are predicated on knowing the future, predicting the future of a company. Instead of doing this, my preferred method is finding great companies and just believing that someday, if they execute, they're going to be worth more. That's a really hard concept for a lot of people to accept. And I fully buy that a company is worth the current present value of its discounted cash flows. I just think that using discounted cash flows is tricky because it's using fancy math to predict the future, which is, by definition, unknowable. So one way that you can invest in a world of black swans is using an anti-fragile mindset. My YouTube partner, Brian Stoffel, for example, the only categories that he looks at when he's making an investment are companies that he believes have anti-fragile qualities, those that can thrive when chaos comes. So he looks at mission, the company's moat, optionality. He looks at cash, debt, cash flow, and he looks at insiders. And is the founder running? Are the employees happy? These are the only categories he uses to invest, the only things he cares about, because he believes that companies that have these categories will be in a position to thrive when chaos comes. It's an interesting way to invest. So when I think about my experience over the last 20 years of investing, my personal inability to understand exponential growth, to understand S-curves, to understand the long tail, to think about the business cycle, to study Ben Graham and Geico, to understand black swans and how they matter, to understand the folly in PE ratios, to understand technology adoption and what happened with Zoom, and that 7% of stocks are the extreme winners, and what drives long-term returns, and my history with Salesforce, and my learning from David Gardner. All of these things have slowly chipped away at my valuation filter. And my valuation filter now looks like this, where I'm focused on buying great companies. And if I find a great company, I really de-emphasize valuation. And I was thrilled when some of my investing heroes, I found quotes of them that say things like this: the big money has been made in the high quality businesses. Or Buffett saying, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Or even Charlie Munger's admission that Ben Graham had a blind spot. Some businesses are worth paying a big premium for. Again, the bigger mistake that investors make isn't necessarily overpaying. The bigger mistake is not buying mega winners. And the number one reason that I have missed out on mega winners is valuation. It's the one thing that has always kept me away. And when you learn that it's really one big winner can pay for all of your losers combined, I'm far more willing today to buy companies, even if I think their valuation is insane. These factors matter so much more to me today than what the current PE ratio is. Does a company have a moat? Does a company have free cash flow? Do they have a long reinvestment opportunity? Do they have low customer acquisition costs? Do they have network effects? Those factors matter to me so much more than valuation. Now, does that mean I don't look at valuation? I literally keep a blind eye to it? No, nor should I think that you should. Instead, I think of valuation today on a spectrum. On the left-hand side here is the return potential that I think I could get in a company or an investment. So at the top of if I think a company has a 10x return, I will ignore valuation altogether. If I think this company's market cap could 10x from today, I don't care what the valuation is. If I think it's a good company and it can 10x, I'm buying it. Conversely, if I think a company's best case scenario is I'm going to get market returns, I'm going to really focus on valuation. So I think the way that I think about valuation today is on a spectrum here, where the higher the potential, the more I de-emphasize it, and the lower the potential, the more I emphasize it. And if your investing style is here, if this is where you're looking for, I think it makes sense to de-emphasize valuation, perhaps even ignore it altogether. If your investing style is here, I think it makes sense to emphasize valuation. and really focus on it because the return potential here is just lower. So if I had to summarize my investing change, it would be the old me put valuation first and everything else came after that. And the new me puts business quality first and valuation comes after that. And this is what I would say my investing framework looks like today, where the first thing I look at is business quality. And if it gets through that quality filter, I'm going to really give it a wide range with that valuation. Thank you.
Thank you, Brian. I appreciate that. It was a great presentation. I thought maybe I'd kick things off with a question. We have about 8 minutes left, and I can definitely see David Gardner's influence on your investment philosophy, and I say that in a good way. We had him on the summit last year, and I think a lot of people looking at this kind of look at it as VC meets public equity, if you will. And I think in some respects they're right. I mean, we're talking about power laws. It's more important to hold those winners than even the losers. But I think a lot of people might think that and feel that, and think that you have a pray and spray approach to what you let into the portfolio. And I know that's not the case because we've talked about this several times, off webinar. So I was curious, like, what is your process for letting companies into the portfolio? I know you have an investment checklist. It's one that I think is a great checklist. And I know you kind of approach quantifiably evaluating a company's fundamentals, their culture, their management, and things like that. And I know you take a real sincere approach to what you let in. So I was wondering if you could maybe talk a little bit about that.
Sure. Yeah, my investing framework has evolved greatly over time by studying great investments, and it really came down to this. I asked myself one day, what are all the traits that I absolutely love in a company? Right? What matters to me? I want a moat. I want it to be mission driven, strong balance sheet, long growth potential. I want it to be a top dog and first mover. I actually really like it when the stock is already beating the market. I want a management team that under promises and exceeds expectations, low dilution, low customer acquisition costs, etc. Just made a big list of every attribute that I really, really want in a business. Then forced myself to rank them. Boy, is that a hard exercise. But I would suggest you do it the same. Go out and make a list of every attribute that you really want in an investment and force yourself to rank them in order. To me, the top things are moat, potential, optionality, invested management team, and strong financial statements. I would say those are my top. Then borrowing heavily from other investors and soliciting feedback from the community, I forced myself to put them into a checklist and score them on a 0 to 100 scale. So I forced myself to say, okay, I think moat is the most important. Well, if you have 100 points to allocate, how many would you give to moat? How important is it to you? Well, I gave myself 20. All right, you say optionality is the next best. How important to you is the optionality of a business or the long-term potential? I said 18. And what was great about that process is I really had to think through, because if I'm stealing a point, giving a point to one category, I'm stealing it from another. So currently I have a system where I can take a stock or a company I've never heard of and take it step by step through my checklist. And at the end, I get a numeric score. Now, obviously, there's huge subjectivity in there. I am literally putting a number next to what do I think this company's moat is worth. I'm putting a number next to the management team and the potential of a company. I'm taking something that's really not a numeric number and turning it into one. So of course, there's lots of subjectivity there. However, I still think there's value in doing so because it forces you to rank your companies against each other, and it forces you to evaluate them on a relatively consistent basis. So from there, I get a kind of a business quality score that shows me what companies meet the vast majority of the attributes that I look for and which ones don't. From there, I ask myself, based on the market cap today, if this company works out, where could I see this company being in 5 or 10 years? right? If it's a $1 billion company, I ask, if this company is successful, can it become a $10 billion company? Is that in the realm of possibility? If the answer is yes, I'm buying it. If it's a high quality company that I think could 10x, it's going to find its way into my portfolio. Conversely, if the company today is worth $100 billion and it's awesome, but if I say, well, this company is going to be worth $300 billion one day, well, that's a 3x return. Yeah, if the valuation is high, I'm taking on a whole lot of valuation risk in order to capture a 3x return. So I'm going to be much more price sensitive with something like that. But to your point, I do buy a lot of companies. I have roughly 70. I know that some investors don't agree with that. I think it works for me. And then I hold them. And the companies that end up performing the best get more capital. And I gradually allow my portfolio to concentrate itself into my top ideas. So my top 20 stocks today are something like 70 or 80% of my portfolio. And I didn't pick them. The market did. The management teams that executed got more and more percentage of my capital. So that's currently my strategy.
Okay, thanks for that answer. That's Michael, did we have another question or two that came in? We have about 2 minutes left, just so you know, Brian. I think you're on mute, Mike.
Unmute the second time. So I think you're talking mostly about investing in hyper growth situations. Is that correct? In most of this presentation?
Yeah, I'm generally focused on high quality growth companies that I think have the ability to grow revenue and profits at an above average rate for a long period of time. I think that is the style that matches my investing style best. And I think that's where some of the biggest winners of the next 20 years are going to live.
Yeah. So do you think about forward earnings in your process? You know, you're not as opposed to trailing metrics, thinking about what could the earnings be in 10 years if this company, if you're investing it sort of when they're in the R&D or early phases of their development, if they could go through that S-curve and, get to the maturity, think about what the valuation could be there.
Yes. Again, it depends on the phase of the company. If a company just crossed over into profitability, the forward PE ratio is going to be far more useful than the trailing one. But again, the forward PE ratio is also just a guess based on forecasting about what's about to happen next. So in general, yes, I am far more likely to use the forward PE ratio than I am a trailing one, and maybe even look at the analyst estimates a few years out. But overall, it's going to be up to the company to execute. So if a company gets through my process and I identify as a high quality company, I'll just buy it. And then it's up to the company to actually execute. And historically, the companies that I've owned that have done the best have had high expectations by the market that they then blast through, which is, again, a really hard thing to comprehend and understand. But that's what the greatest companies that are out there do. They have these very high expectations that they smash.
Well, thank you, Brian, for your time this morning. I appreciate it. It was a great presentation.